Welcome back to our Smart Money Concepts course. In this section, we'll dive deeper into one of the most fundamental concepts in institutional trading, the liquidity game. Understanding how institutions create and exploit liquidity is crucial to your success as a trader. By the end of this video, you'll see the markets through a completely different lens. We will define liquidity and explain its importance in institutional trading. Understand the whale hunting analogy and its relevance to market dynamics. Learn how institutions create and exploit liquidity, and identify liquidity zones on price charts across different markets. Let's begin by understanding what liquidity really means in the context of institutional trading. In trading, liquidity refers to the availability of market participants willing to take the opposite side of a trade. High liquidity means there are plenty of buyers and sellers, making it easy to execute trades without significantly impacting price. For retail traders with small position sizes, liquidity is rarely a concern. You can enter and exit positions without moving the market. But for institutions managing billions of dollars, liquidity is everything. They can't simply place a single large order without dramatically moving the price against themselves. This creates a fundamental challenge for institutions. How do they execute large orders at favorable prices? The answer lies in what we call the liquidity game, a strategic approach to creating conditions that encourage retail traders to provide the liquidity institutions need. To understand the liquidity game, we must first recognize a critical reality. For smart money to execute its strategies effectively, it requires sufficient opposing liquidity. This creates a fundamental dynamic in markets. If institutions want to buy, they need sellers willing to sell at favorable prices. If institutions want to sell, they need buyers willing to buy at favorable prices. Institutions need to create conditions that encourage retail traders to provide this liquidity. They do this by creating price movements that trigger predictable retail trader behavior. Once sufficient liquidity is available, institutions execute their actual intended positions. Let's look at a real example in the gold market. Imagine an institution wants to buy a large amount of gold. They might first push the price down, triggering retail stop losses and encouraging retail shorts. This creates selling pressure, liquidity, that the institution can buy into. Once they've accumulated their position, the price can then move in their intended direction, upward. We see the same patterns in stock indices like the S&P 500. Notice how price pushed below this key support level, likely triggering many stop losses, before reversing strongly to the upside. This is the liquidity game in action. Now let's discuss how you can apply this knowledge in your own trading. The process involves identifying potential liquidity zones, recognizing institutional manipulation tactics, positioning yourself with institutions not against them, and protecting your own positions from liquidity hunts. One of the most common liquidity zones is found at swing highs and swing lows. Retail traders often place their stop losses just beyond these levels. Institutions know this and may target these areas specifically. Pay particular attention to areas where multiple swing points align, or where there are obvious round numbers. For example, in this USD Canadian dollar chart, we can see multiple swing lows around the 1.42 level. This concentration of stop losses creates an attractive liquidity pool for institutions. Understanding that this is likely institutional liquidity hunting rather than a true breakdown can give you a significant edge. Many traders make the mistake of placing their stop losses at obvious levels, such as just below round numbers or recent swing lows. This makes them easy targets for institutional liquidity hunts. Instead, you should consider placing stops beyond obvious liquidity zones, or using position sizing that allows for wider stops. This reduces the chance of being caught in institutional stop hunts. Another common mistake is reacting emotionally to price manipulation. When you see price briefly push beyond a key level and then reverse, Many retail traders panic and make poor decisions. Understanding that this may be part of the liquidity game helps you stay calm and stick to your trading plan. Let's analyze this complete example from the pound Japanese yen market. First, we identify the overall market structure on the daily time frame. We can see a series of higher highs and higher lows indicating an uptrend. Zooming into the 4-hour time frame, we can see price pushing below this key support level, which had been respected multiple times. This move likely triggered many retail stop losses. A smart trader recognizing this as a potential liquidity hunt would look for signs of reversal after the stop run. Our entry would be after price reclaimed the broken support level, with confirmation from price action. We'd place our stop loss below the recent low created during the liquidity hunt, as a move below this level would suggest our analysis was incorrect. As we can see, the trade developed exactly as expected. After running the liquidity below support, price reversed sharply and continued the uptrend. This happened because we understood the institutional liquidity game rather than reacting emotionally to the apparent breakdown. A helpful analogy for understanding this dynamic is whale hunting. In nature, humpback whales use a fascinating hunting technique called bubble net feeding. Whales are the large, powerful entities that need to feed. Small fish are they prey. Whales create bubble nets to herd small fish into dense schools. This makes it easier for whales to feed efficiently. Similarly, institutions create price movements that herd retail traders into predictable positions, making it easier to execute their large orders against this concentrated liquidity. By understanding this dynamic, you can avoid becoming the small fish and potentially position yourself alongside the whales. Let's summarize what we've learned. Liquidity is essential for institutions to execute large orders. The liquidity game involves creating conditions that encourage retail traders to provide opposing liquidity. Institutions often target obvious stop-loss levels to generate liquidity, and understanding these dynamics helps you avoid becoming liquidity for institutions. Before moving to the next section, I recommend you identify potential liquidity zones on at least 5 different charts. Look for historical examples of liquidity hunts and how price behaved afterward. Review your own stop-loss placement strategy to avoid obvious liquidity zones. And finally, practice identifying potential institutional accumulation and distribution phases. In our next section, we'll explore key SMC terminology, including order blocks, breaker blocks, fair value gaps, and more. These concepts will build on your understanding of the liquidity game and help you identify specific trading opportunities. See you there.